If you've just gotten a letter from Social Security saying your Medicare premiums are going up and the number is a lot higher than you expected, you may have just met something called IRMAA. Most people have never even heard of IRMAA until it shows up on their doorstep. And when it does, it can feel like a penalty you didn't see coming. But here's the truth. It's not a penalty. It's a surcharge. And in some cases, you may actually be able to appeal it. In this video, I'm going to walk you through what IRMAA is, how it's calculated, who it affects, and most importantly, what you can do about it. I'm Robin Dall, independent Medicare broker and educator at RobinsWisdom. No call centers, no 1-800 numbers, just straight answers. Let's get into it. IRMAA stands for Income-Related Monthly Adjustment Amount. It's an additional amount added on top of your standard Medicare Part B and Part D premiums if your income exceeds certain thresholds. Most people pay the standard Part B premium, which is $202.90 per month in 2026. But if your income is above a certain level, you pay more, and in some cases, significantly more. IRMAA is not a punishment. It's Medicare's way of having higher income beneficiaries pay a larger share of the program's costs. It's been in place since 2007 and historically affects around 8% of Medicare beneficiaries. But that number is growing as more people retire with income from investments, pensions, and retirement accounts. Here's what really catches people off guard. IRMAA is based on your income from 2 years ago. Not last year, not this year, 2 years ago. So if you retired this year, your IRMAA for 2026 is based on your 2024 income, which may have been your last full year of working. That means a lot of newly retired people get hit with an IRMAA surcharge, even though their current income has dropped significantly. Let me walk you through the actual numbers for 2026 so you know exactly what you're looking at. IRMAA is calculated based on your modified adjusted gross income, or MAGI. I usually say MAGI. Either way, for IRMAA purposes, it has a very specific definition. This is a Medicare-specific version of MAGI, not the same one used for every tax calculation. Your MAGI here is your adjusted gross income, line 11 of your Form 1040, plus any tax-exempt interest income, like interest from municipal bonds. That's it. 2 numbers added together. And this is exactly where people get caught off guard, because this number is often higher than what they think of as their income. In practice, that means it can include wages, taxable Social Security, pensions, retirement account distributions, capital gains, rental income, and yes, Roth conversion amounts. That last one surprises a lot of people. A large Roth conversion counts toward your MAGI for IRMAA because it's treated as taxable income in the year you convert. So even if you're doing it as part of a smart, long-term plan, it can push your income into a higher IRMAA bracket in the short term. What generally does not count are qualified Roth distributions you take later in retirement. Those typically don't increase your MAGI, and that's one reason Roth planning in the years before Medicare can be so powerful. This is also why IRMAA isn't just a Medicare issue. It's a tax planning issue too. Now, the brackets. For individuals, the standard Part B premium of $202.90 applies if your MAGI is $109,000 or below. For married couples filing jointly, the threshold is $218,000 or below. Once you go above those thresholds, the surcharges kick in, and they increase in steps. For individuals with income above $109,000 up to $137,000, or couples with income above $218,000 up to $274,000, your total Part B premium jumps to $284.10 per month. For individuals with income above $137,000 up to $171,000, or couples with income above $274,000 up to $342,000, the total Part B premium increases to $405.80 per month. For individuals with income above $171,000 up to $205,000, or couples with income above $342,000 up to $410,000, the premium goes up to $527.50 per month. For individuals with income above $205,000 but under $500,000, or couples with income above $410,000 but under $750,000, it jumps to $649.20 per month. And for individuals with income of $500,000 or more, or couples with income of $750,000 or more, the Part B premium reaches $689.90 per month. That's more than 3 times the standard premium at the highest tier. And remember, IRMAA also adds a separate surcharge to your Part D drug plan premium on top of that. One more thing that's critical to understand. IRMAA works like a cliff, not a slope. If your income crosses into the next tier by even $1, the full surcharge for that entire tier applies. That means a small increase in income from a Roth conversion, a required minimum distribution, or the sale of a property can trigger hundreds to thousands of dollars per year in additional Medicare premiums. And that cliff effect is exactly why income planning in the years leading up to Medicare matters so much. IRMAA doesn't just affect Part B. It also adds a surcharge to your Part D drug plan premium. The Part D IRMAA surcharge is separate from whatever premium your specific drug plan charges. Medicare adds it directly on top. For 2026, the Part D IRMAA surcharges range from $14.50 per month at the lowest income tier up to $91 per month at the highest tier, in addition to your plan's regular premium. So if you're in a higher income bracket, you're looking at both a significantly higher Part B premium and a Part D surcharge on top of that. It adds up quickly. This is the part of IRMAA that trips people up the most, and it's worth really understanding. Social Security determines your IRMAA based on the most recent tax return the IRS has on file. For 2026, that's typically your 2024 tax return. And that creates a real problem for people who recently retired, had a major income drop, went through a divorce, lost a spouse, or sold a business or property. Your current income may be dramatically lower than the income Social Security is using to calculate your surcharge. Here's an example. Say you retired in early 2025 after a high-earning career. In 2024, your income was $180,000. When you enroll in Medicare in 2026, Social Security may look at that 2024 return and place you in an IRMAA tier, even though your 2025 and 2026 income is now much lower because you've retired. That is exactly the kind of situation the IRMAA new determination process was designed for. Yes, you can ask Social Security to lower your IRMAA if your income has dropped because of a qualifying life-changing event. The form you'll use is SSA-44. You can download it from the Social Security website or pick it up at your local Social Security office. I've also linked the SSA-44 form in the description below if you want to grab it. Qualifying life-changing events include retirement or a reduction in work hours, marriage, divorce, the death of a spouse, loss of income-producing property, like a rental property, an employer settlement payment, or loss of pension income. Notice what's on that list and what's not. A voluntary withdrawal from your IRA or 401k that pushed your income up is not a qualifying life-changing event. A general market downturn affecting your investments is not a qualifying life-changing event either. These are specific life changes, not investment decisions. You'll also need documentation, like a letter from your employer showing retirement, a death certificate, a divorce decree, or whatever fits your situation. If Social Security approves your request, your IRMAA surcharge can be reduced or even eliminated going forward. And one important note, if your income dropped because of a qualifying life-changing event, you can request a new IRMAA determination using Form SSA-44. That's different from a standard appeal, which has separate deadlines. If you're still working and getting closer to Medicare, or if you're working with a financial advisor, IRMAA is worth factoring into your retirement income strategy. A few things to keep in mind. Large Roth conversions, required minimum distributions, or capital gains from selling property can all push your income above an IRMAA threshold in a given year and affect your premiums 2 years later. If you're in the year or two before Medicare kicks in, be thoughtful about large taxable events. That doesn't mean avoiding them. Sometimes they make perfect sense. But it does mean understanding that your Medicare premium in 2 years may be tied to the income decisions you make today. And if you're in the 2 to 3 years before Medicare enrollment, it can be really helpful to work with a financial advisor or tax professional who understands IRMAA. The thresholds are specific enough that sometimes even modest income planning can keep you in a lower tier and save you a meaningful amount in premiums. So that's IRMAA, what it is, how the 2026 brackets work, why the 2-year look back catches so many newly retired people off guard, and how to request a new determination if your income has dropped due to a qualifying life-changing event. If you think you've been hit with an IRMAA surcharge that doesn't reflect your current income, especially if you recently retired, it's worth looking into the SSA-44 new determination process. Don't just assume the number on the letter is final. And if you want to talk through your specific Medicare situation, your premiums, your plan options, and whether IRMAA affects you, that's exactly what I'm here for. Head to RobinsWisdom.com and request a free Medicare review. No call centers, no 1-800 numbers, just Robin Dall, Medicare educator and commissioned remote online notary, here to make 65 feel a lot less overwhelming. I'll see you in the next one.